During the 2008 financial crisis, the S&P 500 fell 55%. Investors who had saved for decades watched half their wealth disappear in months. But one strategy lost only 3.8% during that same crash. And it wasn't a fluke. This same strategy protected capital during the dot-com crash, COVID, and the 2022 bear market, while still delivering 14% annual returns over 33 years. Today, I'm going to show you exactly how it works. If you're a buy and hold investor, here is the uncomfortable truth. The S&P 500 has delivered great long-term returns, about 10.5% per year. But to get those returns, you had to sit through drawdowns of 50% or more. Twice. Most investors can't do that. Research shows that the average investor earns significantly less than the market because they panic sell during crashes and buy back too late. The problem isn't the market's long-term returns. The problem is the path to get there. What if there was a systematic way to capture most of the upside while avoiding the worst of the downside? That's exactly what tactical asset allocation tries to do. And HAA is one of the best implementations ever published. HAA stands for Hybrid Asset Allocation. It was developed by Wouter Keller, a Dutch researcher who has published some of the most cited papers in tactical asset allocation. The core idea is elegant. Instead of holding a fixed portfolio year-round, HAA dynamically shifts between offensive and defensive assets based on a momentum signal. When markets are healthy, you're invested in the best performing asset classes. When a warning signal triggers, you move to safety before the crash arrives. Over a 33-year backtest from 1992 to 2026, HAA delivered a compound annual growth rate of 14.2%. That's nearly 4% more than the S&P per year. The Sharpe ratio was 1.18, which is exceptional. For context, the S&P's Sharpe ratio over the same period was 0.62. HAA delivered nearly double the risk-adjusted returns. But the most important number is the maximum drawdown, only 19.8%. The S&P dropped 55% during the worst crisis. HAA's worst loss was less than 20%. Here is the equity curve. $100 invested in 1992 would have grown to over $8,200 today. The same $100 in the S&P would be about $2,600. Watch what happens during the crisis periods. In 2000, when the dot-com bubble burst and the S&P fell 49%, HAA barely dipped, losing only 2.6%. During the 2008 global financial crisis, the S&P crashed 55%. HAA lost only 3.8%. Look at the drawdown chart below. The red area shows how deep the S&P's losses went. The blue area, that's HAA. It's almost invisible by comparison. During COVID in 2020, HAA limited losses to 5%, while the S&P fell 34%. And in the 2022 bear market, the pattern repeated. So how does HAA actually work? The mechanism has 4 steps, and it only requires action once per month. Step 1. HAA scores 9 offensive assets, things like US stocks, international stocks, emerging markets, real estate, and commodities, using what's called 13-6-12W momentum. This is a weighted average of 1 month, 3-month, 6-month, and 12-month returns. Step 2. It checks a canary signal. Specifically, it looks at whether a TIP, Treasury inflation-protected securities, has positive momentum. This single indicator acts as an early warning system for broad market stress. Step 3. If the canary is positive, meaning the coast is clear, HAA allocates to the top 4 offensive assets by momentum score. Step 4. If the canary turns negative, HAA moves 100% to defensive assets, intermediate-term bonds, or cash. It gets out of the way entirely. The beauty of this system is its simplicity. 1 signal, 1 check per month. No discretion, no emotion, no complex math. Now, let me be honest about the limitations, because no strategy is perfect. First, HAA will underperform in strong bull markets. When stocks just go up for years straight, the defensive trigger doesn't fire, and you might lag behind buy and hold due to occasional false signals. Second, there are transaction costs and potential tax implications from monthly rebalancing. The strategy typically trades about 6 to 8 times per year. Third, past performance genuinely does not guarantee future results. But here's the counterpoint. You're not choosing between HAA and a perfect strategy. You're choosing between HAA and the alternative, which for most investors means riding the full drawdowns of buy and hold. Let me zoom into the crisis periods one more time, because this is where the real value becomes clear. 2000 to 2002, the dot-com crash. The S&P fell 49%. HAA down only 2.6%. 2007 to 2009, the global financial crisis. The S&P lost 55% of its value. HAA lost 3.8%. That's not a typo. 3.8% versus 55. The canary signal caught the deterioration early and moved to bonds. While everyone else was panicking, HAA investors were sitting in safety. HAA is best suited for investors who want strong, long-term returns but cannot stomach the 50% drawdowns that come with buy and hold. If you're approaching retirement, managing a significant portfolio, or simply someone who knows they would panic sell during a crash, this type of systematic strategy removes the emotion from the equation. If you want to implement HAA, BestFolio tracks the live signals updated every month. You'll see exactly which assets to hold and when the canary signal triggers. No spreadsheets, no guessing. We track over 80 strategies just like this one, with real-time signals and full backtest data. The link is in the description. If this analysis was useful, subscribe. I break down a different strategy every week with real data, honest assessments, and no hype. See you in the next one.